So a couple days ago on the channel, I did a video on selling stocks. So I thought today would be a perfect day, absolutely perfect day to do a full-scale video on buying stocks. I'm going to take you through in this video my buying checklist, exactly how this works, exactly how to complete this in this video here today. All 10 of these things you got to do before buying a stock. Then after we get through that, we're going to get through exactly what stocks I bought last week and why I bought the stocks. And then after we're done with that, we're going to go through a major change I have made here recently to the way I personally buy stocks. That's a pretty fundamental change, I would call it. Okay, so a lot of value I'm going to give you guys out. Just drop a lot of gems for you guys. Appreciate you joining me. All I ask in return is that you return with a like on this video. Hit the thumbs up button. Make sure you're subscribed. That's all I ask in return. I prepped this one for several hours last night for you guys here today. Okay, so let's get through this and then we'll get into the stocks I'm buying, why I'm buying them, and all that good stuff. Okay, first thing you got to do before you buy a stock, have you read a 10K? Have you read the annual report of that particular company? Now, this is so vital. Almost everything you'd want to know about a company is in that 10K annual report. And it's so easy to access this overall. Literally, go on to Google, type in Coca-Cola Investor Relations. Let's say you're looking into Coca-Cola, and you can go on their Investor Relations page. Some particular stocks actually have it already listed on Google. So you literally just click on that, and boom, there you go. You got your 10K there. And that's going to take you through so much information about how the business model operates, how long they've existed for. It'll take you through some executive information. It's going to take you through financials. It's going to take you through you could literally read a 10K in a matter of an hour to 2 hours. Suddenly you're going to be very educated on a company that you had no clue about prior to that. It's absolutely amazing. You've gotta do that. Now, I'm hoping on 1000xstocks.com here very soon, I'm hoping to add SEC filings as well. So then you can just type in, kind of like we can type in any conference call, like a ticker symbol like KO for Coca-Cola, and you can listen to a conference call. I'm hoping to add that in next 2000X, but for SEC filings. So then you don't even have to go to a company's investor relations page or those sorts of things, okay? Now, next up here, you got to listen to the latest conference call of a company, at least the latest one, if not the last two conference calls, but for sure the latest one. In that conference call, they're going to give you all the information that is current, exactly what's going on with the company. Analysts are going to ask questions. The management team's going to have to answer those questions. It's a whole process, right? Now, in order to listen to a conference call, if you don't have something like 1000xstocks.com, then you could just type in, let's say, Apple Investor Relations. Now, usually it's not an issue to access a conference call, but some of these companies, unfortunately, and it makes no sense why they do it, but they'll take their conference calls off the website. So for instance, Apple, they only keep up their conference calls for 2 weeks. That makes no sense at all. It's not like it's some big hosting cost and it's like, wow, this is going to break the bank for Apple. It's insane they take it off. But I would say for a lot of companies, they archive their conference calls. So if you want to listen to a conference call from a year ago, on a lot of companies, you can go ahead and do it. Like Meta, for instance, they got their latest conference call that happened way back in April, okay? And they got the previous conference call as well. But some companies make it more difficult. And so just important to kind of understand that dynamic at play there, okay? Now, next up here, look at analyst projected growth for the next 2 years. Usually analysts will only go out 2 years with their projected growth and kind of what they're expecting for the company overall. Usually they're not going to take it out 3 years, 5 years, because they have enough trouble trying to judge where a company's going over the next year or two. Never mind 5 years from now, 3 years from now, 7 years from now, right? Now, in regards to analyst estimates, it's a great starting point to kind of see what these growth rates are. Analysts, you want to kind of look at the average consensus on what our analysts are doing. So like we compile that on 1000X, right? We'll compile that analyst information and basically, okay, current year, analysts are expecting EPS to go up about 37%. Next year, analysts are expecting EPS to go up about 15%. As far as revenue growth goes, right? Current year expected revenue growth about 19%. Next year, around 14%. It's a good starting point to kind of get you to understand, what's going on with these companies, what analysts are expecting for growth rates overall. So very important to go there first, and then you can make your own judgments. And that runs us into number 4, run your own projections, okay? Don't just count on analysts. Analysts could be a great starting point to kind of point you in the right direction of roughly this or that, right? But don't just count on them. Run your own projections. And how you're going to feel comfortable running your own projections is one, experience in the market. The more experience you have in the market, the more comfortable you're going to have doing your own projections. Like all things in life, experience comes in, right? Secondly, after you listen to conference calls of the company, read 10Ks, research company really thoroughly, you're going to feel much more comfortable running projections. Now I say right here, 3-piece or a 5-piece. So basically, this is something I run in my private group a lot. I'll show everybody how to, how I personally like to do projections, okay? Now, what I like to do is I usually like to do a 5-piece. So what's a 5-piece? A 5-piece is I'll put together an ultra bearish case for a company, a bearish case, a base case. Base case is really what I'm, feel extremely comfortable they're going to actually do. Then I have my bullish case. Things are going to go a little better than I expected. And then I have my ultra bullish case where things are going to go way better than I expected, right? And I run all those. And the reason I do that is because I don't just want to count on one scenario. I've got to think about this company in terms of, what if things go way worse than I expect? What if things go way better than I expect? What do I actually expect things to happen here, right? And you should at least do a 3-piece, which would be a bear, base, and a bull case in a scenario, right? So this is like one of my projections I posted back in February inside the private group in the Shopify one, and this runs through. This is probably my base case, I believe, for Shopify here. I can't even remember which one this was, but this is probably my base case, and it runs through what I'm expecting net income to go up, what I'm expecting revenue to go up, why I'm expecting that, right? Where the market cap could potentially go in that sort of scenario. And so, I'm hoping to potentially add something like this into 1000x over time, so I don't even have to, go into numbers and do it. I can just do it in there. That's my hope over time. It's going to save me so much time because those projections it takes a lot of time. Next thing up here, look at valuation versus expected growth rates. This is very, very key. So what you want to do, let's say NVIDIA, right? NVIDIA gets a lot of talk. People talk about, oh, it's a bubble, this and that. Well, is it really? I don't know. Let's think about this a little logically, right? We can see NVIDIA trades at, let's call it just over a 50 forward P. Is that high compared to where stocks in the market usually trade at? Yes. But what's the current year expected growth? I mean, we really started trailing 12-month P, 73. Okay, let's say the market trades at 20, right? Well, 73 is really, really high, right? But what was the company's trailing 12-month earnings per share growth? 755%. Many stocks are in the 8 to 12% range, and they're 755%. What about trailing 12-month revenue growth? 208%. Many stocks are at 4.5 to 6.5%. So yeah, it's about a 3x or a little over 3x where a trailing 12-month P on average is in the market, but the growth rates are like 1,000x, right? It's, maybe not that extreme, but something like that, right? It's not even in the same category. So then you can go ahead and look at forward P, okay, 52. So we can say over, maybe a little over double where average stocks trade in the market. But is the growth rate average? No. Current year expected earnings per share growth, 232. 8 to 12% is where a lot of companies are at, right? And then current year revenue growth, 149% expected, 4.5 to 6.5 is where a lot of these companies are at. So when you look at it from that standpoint, the growth rates of NVIDIA are astronomically high. So it's actually much easier to make a case that NVIDIA is very undervalued right now versus overvalued, right? Just logically, like if growth rates are far exceeding and expected to continue to be far exceeding other stocks, and the valuation isn't even close to being as stretched as the growth rates are, then you might actually have an undervalued asset there, even though the stock price has gone up a lot. Next one up here is you want to look at valuation versus peers. So you want to compare a company versus their peers and try to figure out, okay, is this company a good deal or not, right? So in 1000X, we have the compare feature there. So let's say I was thinking about owning NVIDIA. I'd want to compare NVIDIA versus AMD. I'd want to compare them versus Intel, right? All three of those business models operate differently. It is important to understand that, but you got to try to think about where companies are roughly comped. So if I was to look at NVIDIA, I'd be looking at all the valuation metrics, trailing 12-month P, forward P, 2-year forward P. Then I would start going through the past earnings per share growth, the future earnings per share growth expected, right? Same thing on the revenue side. What about the margins of these companies, right? If I was looking at something like this, I would say, okay, a company like AMD, you have a lot of room to up that net margin and potentially up that gross margin over time. Maybe they can't ever get as high as NVIDIA when it comes to gross margin, but maybe they could get 55%, 60%, something like that, right? And so I'd kind of run through those scenarios, and I love to compare companies versus each other, right? Because at the end of the day, if, let's say, AMD gets your money, well, then NVIDIA's not getting your money, then Intel's not getting your money, right? Let's say you buy NVIDIA stock, well, then AMD's not getting your money, Intel. These stocks are battling for your money. You got to understand that everybody's only got a finite amount of money. It doesn't matter how rich you are. It doesn't matter if you're staying at the plaza, okay? Listen, everybody's got a finite amount of money. These stocks are fighting for your money. And so it's very important when you're picking these stocks, you're investing in the right ones, because the difference in alpha can be tens of percent over a year. It could even be 50%, 100% in just a 1 year span, right? I mean, imagine you bought Meta in the fourth quarter of 2022. Imagine you bought Apple in the fourth quarter of 2022. Well, Apple's giving you a decent return. Meta's giving you an astronomical return. Imagine we're at the beginning of 2023 and you're thinking about, should I buy NVIDIA stock or should I buy Google stock, right? Well, shoot, if you bought Google stock, you did okay for yourself. If at the beginning of 23 you were buying NVIDIA stock, I mean, that's pretty much almost a life changer for a lot of folks, right? A life changer. And that's not that long ago. So it's important you compare these companies versus each other. Next up here, you want to look at the last 3 to 5 years in an income statement. But what are you looking for here? Well, so I want to see revenues that are continually going up year after year, right? So this company went from 392 to 578 to over $1 billion of revenue. I like that. I also want to see gross profit rising substantially. 251, 390, 724. I like that. I want to see net income going up substantially, 21 mil to 61 mil to 127 mil. I want to see earnings per share going up dramatically, diluted earnings per share and basic EPS. I want to see all that, right? By the way, if you're wondering what company that is, elf on a shelf, right? Elf on a shelf. That's what we want to see in an income statement really over the past 3 years. Then we want to look at the balance sheet over the last 3 to 5 years. What do I want to see in a balance sheet? Well, I thought rather than show you what I want to see, I'll show you what I don't want to see and think of it as the opposite, right? So RH is a perfect example. Look at their cash and cash equivalents over the past few years, right? They had 2.1 billion, then 1.5 billion, then 123 million. Now in their latest report, they're down to $101 million of cash and cash equivalents, right? Not good. That's not something I want to see. I want to see cash building as the years tick on, not going down, right? And then if we look at long-term debt, it's gone up substantially over the last few years as well. They went from 579 million in debt to 2.1 billion to 2.4 billion here recently. So also not something I want to see. So I want to see debts going down over time for a company in their balance sheet. I want to see cash and cash equivalents, short-term investments, long-term investments going up. A balance sheet gives a company strength to get through hard times, right? You look at a company like RH, let's say their business got a lot worse. They're going to have to make some dramatic decisions on, do they dilute shareholder value at maybe a poor stock price, right? Do they take out a ton more debt at high interest rates, right? Do they have to, do discounting on their merchandise, which hurts long-term brand value? Like, what do they have to do? If you have a ton of cash on the balance sheet, you don't have to deal with those things. You can get through a tough time, and it is what it is. Because tough times do happen for businesses. It happens for all businesses. And some businesses go 5, 10, 20 years without having a tough time. But eventually, even for those companies, a tough time does come. When growth isn't quite there, when profitability gets hit in a major way, when they have to deal with this and that, legal expense, whatever. And so it's important. A good balance sheet positions you in a position of power. No different than an average person. Think of yourself. You're in a position of power if you have a great balance sheet. If you have a ton of cash, right? If you have a ton of long-term investments, short-term investments, if you own some real estate investment properties, if you have relatively low debt compared to your assets, guess what? You're in a position of power. If the economy gets bad, you can go snap up stocks for cheap, or crypto, right? Bitcoin. You can go snap up real estate for cheap, right? Real estate investment properties. You're in a position of power. And you're also positioned to get through a tough time, right? Let's say you're going through a high inflationary time period, and the Fed has to raise rates substantially, well, if you got a lot of money around, you can get 5% on that, let's say, for instance, right? If you're loaded up on debt, then every bit of income just keeps going toward that debt to try to pay that debt down, which a lot of times it won't be paid down because your interest rate you're having to pay on that is taking up a lot of the capital, right? So just like in our own lives, if you're in a position of power, it's huge. If you're not, you're in a tough place, right? Next thing up here, know your CEO. This is cake. This is cake. Google. Nowadays it's not hard to find out, who these guys are, who these gals are, right? So if I wanted to buy PayPal stock, I'd type in PayPal CEO. I'd start Googling them, researching, okay, what's their past? Okay, they did this, they were at this company for this amount of time. Okay, YouTube, you can watch some old interviews of these folks because sometimes, if they've been around the block for a long time, they've got old interviews archived that you could watch what their thought process was 5 years ago before they even with that company, right? And kind of judge them and all those sorts of things. And when it comes to judging CEOs over time, there's another thing, experience helps. The more experience you get in the market, okay? Next one up here. This is what I call 50% versus 100% next 3 years. So what that means essentially is what are the chances, I like to think in this in terms of a risk-reward standpoint. What are the chances I'm going to lose 50% or more of my capital over the next 3 years in the stock versus the probabilities I'm going to 2x or more my money in the next 3 years in the stock? And I love to think in that frame of mind because that allows me to then to really think about what's the level of risk I'm taking in this position versus the potential upside. Because sometimes if you're not thinking in that thought process, you can get into some highly risky positions and you're not even thinking about the risk. On the flip side, if you can get into some stocks that, if you're not thinking that frame of mind, you're not even thinking about is this stock really have good upside ahead? Because if you're buying an individual stock, it's got to have some good upside. Otherwise, why are you doing it? You could just have your money in a savings account or something like that, or just invest in an S&P 500 index fund. To buy an individual stock, you got to feel like there's a good amount of upside there. Significant upside. Way more alpha than you can get in the S&P 500. Otherwise, it's not worth doing, right? So that frame of mind, I think, matters significantly. So the way I kind of think about this, right, is in terms of on the downside, like the chance I lose 50% plus, I've got to think about could the valuation of this company get compressed so low that I lose 50% or more of my capital over the next 3 years, right? So for instance, for Meta, let's say I was thinking about buying Meta, right? Okay, Meta trades at a 2-year forward P of 20. Could Meta get pushed down to a 10? Meta, I don't see that being realistic. If anything, I think they're going to command a higher multiple in future years. And when I'm talking multiple, I'm talking P ratio than they command now. So I don't think that's very high probability at all. Now, if Meta was trading at a 55 2-year forward PE, then I might be concerned because then I might be thinking, okay, who's to say Meta can't get compressed to something in the 20s, right? And then I'd be thinking, okay, there might be actually some good amount of risk in this one. It is possible I could lose 50%. When you're trading at this sort of multiple, it's hard to get, justify that going down to a 10 multiple. It just doesn't make sense, right? Unless the company was completely done at that time, which just doesn't also seem realistic, right? And then I like to think about, okay, what are the chances the analysts are wrong and I'm wrong about growth rates, right? And so that not only will the company not grow EPS and revenue over the coming years, but they would actually shrink earnings per share and revenue over the coming years. That's the way I like to think, right? And so once again, for Meta, can I see their earnings per share going down over the next few years? No. Can I see their revenues going down? No. Not even in a super bearish scenario do I see Meta's revenues and earnings per share going down over the next several years. So for Meta, I would put this at an extremely low probability, like insanely low, that I would lose 50% or more if I'm buying the stock today. I'm not talking about when I bought the stock years ago. If I bought the stock today, there's an extremely low probability, regardless of what happens in the market and the economy, that I lose over 50% of my money in the stock over the next 3 years. Extremely low probability. Now, what are the chances I 2x? So how I like to think about this is, what are the chances I could get, multiple expansion in this company? And what are the chances this company might report better growth rates than where analysts are at, and maybe even where I'm at, right? So if I'm looking at Meta, could I see there being some multiple expansion here over the next few years? Yes, I could. I could see them starting to command maybe a forward P of 30-ish. And the reason I would feel comfortable with that happening is if you look at a lot of the other big techs, they're in the forward P range of like 30 to 40 for the most part. Meta's an outlier, trading at a 24. So I could easily see there being multiple expansion in Meta over the next few years. And could I see also them growing at, let's call it a little more rapid clip than where analysts are at? I could also see that as well when I think about how many different growth projects this company has going right now and over the next several years. So I think there's a decent probability. I wouldn't say there's a super high probability Meta will 2x over the next 3 years, but I think there's a pretty decent probability that it could 2x or close to 2x. And there's an insanely low probability I would lose over 50% of my capital over the next 3 years. So therefore, Meta is a very attractive risk reward, even at $494, right? So that covers that, okay, my checklist. I hope you guys got a lot of value out of that. Now I want to go ahead and get into these next two subjects, exactly what stocks I bought this week, why I bought these stocks, and then a major change that I have made to the way I buy stocks, which is I would call a fundamental change. So what stocks did I buy this past week? Well, here's the 4 stocks I bought this past week. I bought PayPal, I bought Winning Resorts, I bought Nike, and I bought Honest, actually. For the first time in a long time, I bought some Honest shares this past week. So why did I buy each of these? PayPal, that's a play on valuations way too low, forward P in the 12 range. Growth rates, I think, are going to come in better than a lot of folks anticipate. So with PayPal, I'm looking at that as, if I was to think about here's the deal with PayPal. It's $60 here today, right? Let's play the game of what are the chances I lose 50% of my capital in the stock over the next 3 years versus 2x or more of my money in the stock over the next 2 years. Okay. So in regards to PayPal, insanely low probability, in my opinion. I lose over 50% of my capital. Buying it at 60 today, is the stock 3 years from now $30? Pretty low probability. Could I see the forward P going down to 6? No, not very probable. All things are possible, but it's not very probable. Could I see the multiple actually expanding to an 18 or a 24? Yes, I could see that happening. That would make a lot more sense over this next few years. The valuation right now doesn't make any sense given the growth rates this company has. Never mind, they're about to get in this advertising business, which is going to absolutely likely skyrocket the EPS and the net income of this company over the next few years. So when I look at PayPal, I think there's an extremely high probability I 2x my money or more over the next 3 years, meaning the stock goes to at least $120, if not $180 or $200 over the next 3 years, right? And it's a very, very low probability that I, lose over 50% of my capital in the stock over the next 3 years. Winning Resorts, a very similar situation. Win Resorts, this one, $89 is a stock when good times, usually trading at $200. If I look at this one, what are the chances over the next 3 years I buy the stock at 90 and it goes down to 45? Outside of an epic depression in the economy, not very realistic. Not very realistic, right? When I think about when they really cater to the highest income earners, they really cater to the highest net worth, the top 10%, and those folks always have money to go to the win and have a good time, right? Whether that be in Asia, in Macau, right? Or whether it be in the United States. And when it comes to money printing, when it comes to keeping the show going, really in China, they're going to continue to obviously inflate that economy over time. And when it comes to the United States, there's no signs that anybody's going to cut anything. And that comes from both political parties. If you look at who both the presidential candidates are, for instance, coming up for this next election for the next 4 years, both of them are money printers. So neither guy is likely to put on the brakes in any sort of way at all, just to be quite frank. And so therefore, if anything, the economy is going to inflate over time, right? You'll go through tough times here and there, and recessions can still hit, but at the end of the day, they're just going to spend. And we all know the Federal Reserve, what do they like to do? If employment market gets hit at all, right? Next thing you know, the Fed's backstopping everything. They're very quick nowadays, very, very quick. And that's the way it'll remain. That's just the way it is, right? So Wynn Resorts very well positioned over the coming years. As interest rates do eventually drop, that's going to also help Wynn in regards to their projects. And they have a lot of exciting projects. I mean, the Middle East project is incredible. That should be completed at the beginning of 2027, likely. And then they're working on hopefully doing a project here in New York City where I'm at right now, which was just going to be absolutely epic if they can pull that project off. That's not a for sure. They also own land right across the street from their current Wynn and Encore properties in Las Vegas that if they want to expand, they also have opportunity to expand in Macau if they want over the coming years. So, Wynn's in a really, really good position, and their brand is as well positioned in the marketplace that I've ever seen it, just to be quite frank. And there's really, I'll be honest with you guys, since Steve Wynn left years ago, I gotta say, I think the company might even be more well run, which is shocking because that almost never happens. Almost never happens where a famous CEO like that leaves and the company is arguably even better run. And I can make a strong argument that the company might even be more well run today than actually when Steve was running the company, which actually makes me think this company should deserve actually a premium multiple versus they used to give Steve Wynn a premium multiple. And that, like I said, I'm kind of shocked by that whole situation because I used to think like, ooh, Steve's gone, like maybe the place is going to go downhill. Nope. If anything, I think they've taken it up a notch, which was once again shocking to me. Nike's easy money. I don't know what else to say about Nike. Like, put me to sleep. Like, if I think about a stock that's just easy money, this is Nike. And Nike's one of those you can just buy, hold. I almost look at Nike like an index fund, except I would expect Nike to outperform index funds over the next 5 years. That's the best way to put it. It's very similar to like put money in an index fund. It's just I expect Nike to outperform, but just easy own. And then honestly, I've been so long since I actively bought the stock. I've held the stock for years, but not actively bought it. But it's one of the most shocking turnarounds I've seen in a company so far. What Carla has done with the business, the margins are exploding for them without even having to go up substantially in price in their categories. The margins are, which means they're just running the business a lot better. It just seemed like Nick, the gentleman who was running that company before, I don't know, maybe he just didn't know how to run a company because the margins are exploding for this company. They're getting close to that flip to actual profitability now at this point in time. And once they flip there, I don't think they're ever going back again. I think they're going to remain profitable there on out. And then I'm looking at the revenue growth of the company as well. And I'm like, Carla's doing a heck of a job running this company. And so at $2, I gotta take a flyer on that because now I would say the odds of bankruptcy for this one have basically been eliminated. They're now sitting on 30 mil cash, 30 mil plus of cash, which is a huge amount for a company their size. This is a little teeny company, by the way. I mean, the market cap on Honest is like $200 something million. It's an insanely small company. So the amount of cash they have is insane. And they're debt free on that balance sheet. And then flipping over to profitability, the risk reward there is insane. And so, it's a tough one because I like some other of these like kind of like $1, $2 stocks, like a Fubo comes to mind, but Fubo's a lot riskier. I will say that because they haven't got to that place yet of getting to that like flat line bottom line yet. If Fubo does that, that's going to be huge upside in that one too. But Honest has done that. So now we're setting up to like, now let's start bringing in some actual net income, right? And then once we do that, then we're a profitable company. Then you 100% take off the whole BK thing, right? Which I already think that's like 99% off the table now, but we can just eliminate the rest of it if you're consistently profitable. And then it's about how profitable do we get? Are we talking $10 million in net income a year, 20, 30, 40, 50, 60, 70, 80, 90, right? And that's where things get really, really fun and honest. And all of a sudden it goes from a $200 something million market cap to $1 billion or $2 billion, whatever, right? So yeah. I wouldn't be surprised if I keep buying that one. Now, major change I made to the way I buy stocks here recently. And so here's the deal, okay? From basically when I got in the market at the end of 2008 through 2022, I've always done random buys, not consistent buys. Even if I go back to the days I worked at Walgreens, I might buy stocks every 3 weeks or once a month. If I go back to my Quick Trip days, I might buy back-to-back weeks. I might buy, I might take 2 weeks off between a buy or 3 weeks off between a buy, right? But it was always kind of random. And then when I started my real estate marketing company, same thing. It's never been consistent. But then I made a change. In 2023, I started the Patreon, right? Which was a way people can see what stocks I'm buying each week, right? Start a portfolio from scratch with a very modest amount of $150 a week and consistently buying that portfolio and show people how to, I build a portfolio from scratch, essentially, right? It's been phenomenal for everybody in that Patreon to see that. And I really liked that. And then in 2024, I said, well, let's up that Patreon to 250. I asked people, should I up it to 250 or should I keep it 150? We had more people vote for 250, so upped it to 250 this year. And then I also started in the public account, which now is a $2.1 million portfolio that I started in the private group. Started that like 7 years ago or 6 years ago or whatever, right? And I said, what if I start buying every single week in there, $500, right? And so started that as well. And I love it. And so what I'm now I've started doing is now I'm even going to buy in my private accounts every single week, which is a big change for me. And the reason I'm doing it is kind of, I think, 5 reasons. One is it cuts down on trying to time the market, because when you do inconsistent buys and let's say you save up, a big amount of money, you kind of feel like you're trying to time the market, like, oh, maybe stocks are going to go down this week, the Fed's going to say this, or this is going to happen. And you kind of get into that feeling, which you need to battle against that feeling as a long-term investor of trying to time the market. We know it doesn't work. We know the whole time in the market, sometimes you can get lucky and maybe you time it out, but it's a bad strategy. And so by starting this consistent buying week in and week out, and it's not to say I'm not going to buy random amounts here and there every once in a while, but if I'm buying consistently in the public account, the Patreon, and my private portfolio week in and week out, it really takes a lot of the feeling of trying to time the market away, and it's just gone, right? Second thing is it reduces stress big time, because the problem is if you're saving, let's say, a big amount of money, or, let's say I'm like, yeah, man, stocks went up a lot this week, I'm not going to buy this week. And then the next week comes and stocks go up again. I'm like, oh, dang, man, I'm not going to buy again. And then you start stressing. You're like, well, why didn't I just buy the previous week? Because now stocks are even higher. And then stocks go up the next week. And you're like, dude, like, what am I doing here, right? And then stocks go down a little bit. And you're like, oh, okay, finally, and I'll just finally buy, right? And it's a stressful thing to go in. And once again, it gets into timing the market, and it's stressful to have to go through that, and there's no real need for that stress if you're just consistently buying out there and not worrying about, okay, the market went up this week, it went down, okay, here's I can buy, and then all of a sudden the market goes down a bunch more the next week, and you're like, oh, why did I buy last week? Like, I should have just kept it until this week, right? And it's a stressful thing. You shouldn't have to put that level of stress on your shoulders as a long-term investor, right? Because at the end of the day, the numbers are going to be small relative. I mean, think about it. If you're investing over the next 30 years, if the S&P 500, if you bought the S&P 500, let's say, for instance, right, and what I do is individual stock, but let's just say it's S&P 500. If I bought the S&P 500 1% down versus 3% up, does it make a difference 30 years from now? It makes no difference. But all it did was just put a bunch of stress on my shoulders about that 4% difference there, right? Third thing is something to look forward to every single week. I loved that feeling of like I'm buying stocks. It gives me something to look forward to every single week. I love adding assets. I love buying assets. Like, it gives me like a good feeling inside, I guess you can say, right? Fourth thing is puts me on constant offense. If I'm thinking about I'm buying stocks every single week, I'm on offense, right? And it's much better to feel on offense than defense. If you're just kind of stacking cash, waiting for the perfect time to buy, you kind of feel like you're taking a defensive posture, which I can tell you is not as much fun and not as enjoyable as an experience, right? Ask perma bears that. They're constantly in cash waiting for the big crash, and it never comes. And then it finally does come, and then they wait for it to go down even more, and never does, and then they miss out on the upside there, right? And the fifth thing is, it makes me never fear crashes or corrections, because if I'm buying every single week, I'm not scared. Send the market down next week. Okay, great. I'm buying next week. Send it down the 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 next week. I'm buying every single week. It's all gravy for me, right? And so if you're buying consistently, you don't have to fear the crashes. You don't feel the corrections. You're actually hoping for it, because you're like, I'm buying. I'm going to take advantage of deals. I hope Nike's $93 next week. That'd be awesome. I'm not selling Nike for years. So if Nike's 93, that's just easier for me to add. I hope Wynn's 79 next week instead of 89, right? I hope PayPal's 58 instead of 60 next week. So that's that, guys, okay? Appreciate you joining me here today. If you're looking to apply, join my private group. Get access to all my best course curriculums, teaching you everything I got up here, including a lot of in-depth videos like we did here today, exclusive content weekly, plus be part of the 6- and 7-figure Discord chat with a lot of high-level folks. And we'll send you a membership card in the mail. Pin comment down there to apply to join us in there. Much love and have a great day.